Hello and welcome to Quarterly Context webinar for the fourth quarter of 2017 for clients of the advisory group and WealthStep. WealthStep is a division of the advisory group that provides a simplified service for up-and-coming individual clients as well as 401k client participants. Quarterly Context webinars are designed to provide high-level perspective regarding the economy, markets, and investor behavior patterns in order to help both our personal wealth and institutional clients better achieve their goals. We try to keep these meetings to around 20 minutes, and we will circulate a video link as well in case you'd like to view it again or pass it on to someone that you think we can help like we've helped you. If you have any questions, please submit them to the question box, and we'll either address them as we go or at the end of the presentation. First, we always want to remind people to focus on what matters and what you can control when you're considering your goals. The most important dynamics regarding short and long-term goals in terms of what you desire and what you require in terms of your long-term plans and outcomes. In terms of the market, it was quite a strong quarter and quite a strong year with what some are calling a melt-up rally instead of a meltdown, pushing the Dow and other stock market indices to new highs in many cases, with positive returns across the board in stocks and bonds for the year and for the quarter being here above and the year being shown here. The highest return for the year was 37% for emerging market stocks, which came off after a period of weaker returns for emerging markets, which is a good reminder of the value of discipline and diversification. Overall, the bond market stayed relatively stable despite one interest rate increase during the quarter and by the Fed. Stocks shrugged off a lot of mixed news, including political challenges in the U.S., a Brexit divorce initiation, Middle Eastern conflicts, North Korean missile testing, and more. During this time period, the tax bill was also passed in Washington, and the fire and fury comment by Trump was made, which ended a long winning streak of quite a few days. Later, the Dow did continue to push forward and reached a new high of over 26,000 in January after the end of the fourth quarter. Let's take a peek then at recent news. Just a reminder that short-term events can sometimes push the market around. Not a lot of volatility, as you can see here, but still news does cause short-term blips that tend to be relatively inconsequential in the long run in isolation, with a longer-term chart shown here in this small section. In terms of the economic snapshot, GDP, gross domestic product, was relatively strong at 3.2% for the third quarter. Fourth quarter numbers haven't quite come out yet. Corporate profit numbers were strong. Consumer spending was solid, although not especially strong. And business spending had some significant pickup. As mentioned, the Fed raised rates and continues after initiating in October the reduction of stimulus through allowing existing bonds to mature rather than repurchasing. Inflation up a little bit, unemployment down a little bit, the lowest level since 2000. Wage growth was down a little bit, which is a bit of a concern from a consumer direct economic stimulus standpoint. Consumer confidence was up slightly. Housing up slightly. Oil had a bit of a jump, 2 quarters now in a row with material jumps that may have something to do with OPEC essentially colluding to curb or limit oil output until through the end of 2018. The US dollar had a weakness, losing about 10% relative to a basket of international currencies, while the euro hit a 14-year high. In terms of a macro view, or stepping back from some of those economic factors, you can see the longer-term patterns here, where unemployment has been gradually coming down for quite a number of years, since around after the global financial crisis. Wage growth has been hovering at about the same level. Inflation here remains tame, although is picking up just a little bit. Consumer sentiment hovering around the same level. And as you can see here, oil prices have picked up a little bit. In terms of what is continuing to push up stock market prices, one of the bigger drivers and that is causing some market prognosticators and economists to feel a little bit more comfortable with relatively higher valuation levels, which might otherwise cause some concern, is the stronger earnings of corporations, and the projected earnings are continuing to follow that pattern for the near term. The cash levels of corporations is relatively high. That may lead to additional buybacks. And buyback periods, as you can see in this chart, tends to coincide or precede a cooling off in the markets. And the tax plan, which reduced corporate tax to a little over 20%, may lead to additional buybacks and dividends as well. So that's one factor to keep an eye on. Non-financial debt or the debt of non-financial corporations rather, is hovering around 45%, so at highs relative to prior to the global financial crisis, but interest rates are lower relatively, and so debt service is more manageable, so that's not quite as much of a concern as it might otherwise be. However, the trend here is worth keeping an eye on. Also, there's been a lot of talk about the 3% growth rate for a couple quarters in a row. Here you can see other periods in recent decades where 3%, there have been consecutive 3% GDP numbers in the mid-90s, the end of the 90s, a couple of periods in the mid-2000s, and around 2005 and 6. And then, 2015 and 16, and now more recently at the end of 2017. In terms of the big picture of where markets are, what the patterns are, the post-global financial crisis period, you can see here in blue on an inflation-adjusted basis with numbers higher than other previous difficult markets, what we call the 4 bad bears, so relatively strong recovery, inflation adjusted versus other markets. There's been a lot of talk about Bitcoin recently, with a very rapid run up since 2016, and a couple of months ago we encountered a chart in an article that's shown here that shows the typical pattern of a bubble here in green, just generally speaking, and then shows the Bitcoin pattern, which follows similarly in that pattern and shoots a little bit higher. And then almost immediately after this article came out, not that it was driven by that, the price of Bitcoin started to fall, and you can see in this lower chart how that price has reacted to until just a few days ago. Interestingly, following almost an identical pattern to the green general predicted bubble line shown above. So almost a 50% drop since the high of the $19,000 price, or just a little bit over 19,000. We have here an updated and different version of the periodic table. In this case, rather than ranking all the different asset classes by year without any relative information, here the 0% return line is shown in the middle. So you can see then over time which asset classes have performed positively or negatively and in what order. It's interesting to note that there's been low volatility in the last decade, with really only one year having material negative returns across the majority of asset classes back in 2008, associated with the global financial crisis. This is also the time of year where the new Callan capital market expectations come out, and the projections are unchanged this year for the 10-year forward-looking numbers relative to last year's 10-year forward-looking numbers. And the projections continue, therefore, to be under long-term averages, given the econometric forecasting and given the relatively strong run-up in recent years and the idea that returns generally eventually revert to the mean. The question is, how quickly will they revert to the mean? And much of the recent run-up was in the process of reverting to the mean to offset the global financial crisis market drop. Putting last year's return into perspective, we can see for 2017, the S&P 500, a U.S. stock market index, broadly speaking, was up almost 22%. Quite a strong return. That's the highest return we've seen since 2013. And you can see where that falls in the bucket of 20 to 30% returns. And you can see as well overall that the 5 columns on the left here represent negative full-year returns, whereas the bulk of returns over time fall in the positive range. Notable that there's been only one negative U.S. stock market year since 2002, and the 2008 return was a notable drop, and the recovery has produced for the last 5 years almost a 16% annualized return, which is about twice, actually more than twice, what the projected return is for stock markets moving forward for the next 10 years. So keep your expectations in check. Enjoy the strong returns that have happened recently in recent years, but don't expect this same level of return moving forward. It's expected the returns will have more moderate cooling returns relative to recent past. Looking at valuations, you can see what the pattern is here using PE as a measure of market price reasonableness. Still within one standard deviation or a band of prices, with the current S&P at just over 18, PE of just over 18, and elsewhere, we can see the range of where we are currently in the blue diamond here versus the 25-year average, and then the range of returns in gray. So looking at a longer time period. So for the most part, it suggests that the U.S. is slightly overvalued in stock prices relative to the long-term trend, but not dramatically so. With other major foreign economies being roughly in line, although Japan is a bit of a unique story, and emerging markets now, after a strong year, are no longer quite as attractively valued as they were. You can see here the pattern of the dollar as well, increasing in value, cooling relative to other currencies, increasing, and more recently a little bit of cooling again. Then again, we can see the stock market volatility as measured by the VIX index, and you can see some of the historic lows that are shown at the far end of the chart here. You can also see that when just before volatility spikes, and those spikes are associated with market downturns, just before markets have those downturns, volatility tends to be especially low, and markets are especially low now. There's nothing obvious that would suggest there would be a market downturn, but surprise events can happen, so it's important for people to manage their expectations and be in a portfolio that makes sense for their life stage, or in the case of an institution or foundation endowment, consistent with their long-term goals. In terms of investor behavior, an update of the mutual fund industry cash flow chart. You can see recently there has been cash and pumping in some level into late in the cycle into bonds, just as bonds have been rates have been rising and a little bit bumpier in terms of returns. And then the broader patterns tend to be people chase markets, push money in and out at following market patterns as opposed to being disciplined about it. In the fourth quarter, investors, broadly speaking, pulled about $36 billion out of stock funds, and more money flowed out than flowed in. And individual investors, looking farther back since 2012, approximately $1 trillion came out of U.S. stock funds out of concern and nervousness following the global financial crisis and a challenging 2011, causing people to miss out on a really strong run-up. However, individual investors have been pushing money back in very recently, which is part of what's causing the recent strong returns, and that may lead to disappointment when volatility increases a bit. In terms of the quality thermometer, for the quarter, high quality outperformed low quality stocks. High quality stocks are those that have more stable cash flows, better balance sheets, less debt, and so forth. And for the year, it was mixed with large cap value and mid cap value in particular being strong in quality, but small cap in general and growth in general having stronger returns in the lower quality segment of the market, the more speculative side of the market. In terms of the periodic table for quality, you can see there's a bit of a trend where quality has been improving in terms of returns, relatively speaking, over recent years, and that is despite relatively strong equity market returns. Quality tends to do better when markets are flat to negative, providing a little bit of downside protection on a relative basis. In terms of value added, the process that we utilize for investment manager mutual fund research involves quantitative and qualitative analyses utilizing our internal investment committee and the research efforts of Callan Associates. And that combined with a disciplined process, as shown in previous handouts and illustrations we've done about studies showing that both individual investors and institutional investors tend to replace managers too soon, only to have the manager they replaced or fired do better than the manager they hired. Contact us if you'd like to revisit those studies that we've done summaries of. And recently there was an article in the Wall Street Journal highlighting that major rating services, for example, in this case, Morningstar, which does some good work and has a good quality set of analysts. When people rely on the Morningstar star system, oftentimes leads to subpar results, essentially because those rating systems are heavily tilted towards recent performance, and that leads to market chasing to some degree or disappointment when managers naturally have their cycles of performance. And if investors are drawn to those that have recently performed very well, it may be that those managers are just about to have their weaker part of their cycle. So using a solid prudent and proven manager research process can add value over time. In terms of the asset class corner, here we can see updated information about the proportions of markets. The U.S. has been growing as its proportion after a number of years of shrinking a little bit, as international markets previously were growing more relative to the U.S. Now it's closer to 50-50. International developed markets represent 30% of the overall global stock market in terms of capitalization. Emerging markets represent about 12%, and the REITs overall market is split about 40-60 between the non-US and US REITs, and the non-US component has been growing here over time. In terms of 401k plan and other self-directed insight, there's some best practices that can be learned from studies and analyses. First, some research or projections show that the purple line here, for example, consistent savers tend to have the best outcome, but using auto escalation comes in a pretty close second. So for plan sponsors who really want to move that needle, using auto escalation can be helpful versus people who start, even if it's automatic enrollment, but leave it sometimes by default, believing that their plan sponsor might have suggested a specific rate, leaving it at that rate given inertia patterns that are oftentimes the case, leads to a dramatically lower overall outcome for people. There was also a recent Callan survey for defined contribution plans. It showed that the priorities of plan sponsors are retirement readiness, plan fees, in particular with regards to record keeping and other service providers, and then communication. So the two of the top two are about trying to move the needle for plan participants. There's some pattern of per participant charges being a more common method for addressing plan costs, while revenue sharing is used to a lesser degree, a decreasing degree. For those of you that do not currently have a fee policy statement, that may be something to explore. It can help address some of these questions about per participant charges, and can be a healthy discussion into formulating a policy for your plan. Then there's information discussing how plan fees are typically paid in terms of investment manager fees as well as administrative fees, and the bulk of the participant-driven fees are covered through explicit dollar fees or percent fees, with only 27% now being covered by revenue sharing. This is a survey of relatively large plan sponsors. In terms of the rules and regulations corner, not a lot to note. The Consumer Financial Protection Bureau director stepped down, and there's an overhaul that's expected in terms of leadership there that may lead to significant changes which could reduce the protection of the average consumer. The CFPB was originally created about 6 years ago, so it's a relatively new agency. This is the same note essentially as last quarter, but because it's still pending, are mentioning here again that some of the transition to the fiduciary rule are pending for the middle of 2019, have been pushed out to that time frame. For foundations endowments, now with capital market expectations coming out, it's a good time to revisit spending policy and make sure that that's ties in consistently with your asset allocation. So I want to thank you for your time and attendance today. We are always interested in hearing your thoughts, and anytime you have feedback, we welcome that and are always interested in knowing what we can do better to serve you. Thank you very much, and we look forward to speaking with you soon.